This is part 3 for preparing consolidated financials with a non-controlling interest. And in this example, we're going to actually do working papers. And you'll notice that we have a new column on those working papers. On the consolidated balance sheet, a credit balance account called non-controlling interest is set up to recognize the non-controlling stockholders' investment in the subsidiary. Beginning in 2009, the non-controlling account appears in the owner's equity section. Now, on the income statement, there's an account called non-controlling interest in subsidiary net income. It's reported to recognize the non-controlling shareholder share of the sub's net income and reduces the parent's consolidated net income. So what we do on the consolidated financials is show 100% of the sub's revenue and expenses. Then we show combined with the parents, we show a total, and then we have this line item that backs out the part that goes to the non-controlling interest. Non-controlling interest. The consolidation process remains substantially unchanged for the non-controlling interest. Consolidate as though the parent has 100% ownership, then determine non-controlling interest in the subsidiary at the beginning of the current year, and sub's current year net income, and sub's current year dividends, and subsidiary as of the end of the year. Now let's take a look at an example. On 1/1/16, Big purchases 90% of Little for $1,710,000 cash. Little has total equity of $725. Little also has a customer list valued at $800,000, not recorded on the books, with a 10-year life. The first thing we want to do is prepare a fair value allocation table so we can determine how much to amortize and how much will be assigned to goodwill. So here is our fair value allocation table. I always like to take the consideration to 100% and then back out the total book value, assign the amount to the undervalued assets to come up with goodwill. And then I also, at this point, determine my amortization at 100%. So remember, equity is the same as net book value. Again, I like to use 100%. It's just how I do it. You can do it whatever way you want. Now, allocation of excess assets and goodwill. We have total, and then we have big. Non-controlling interest, we have the book value, which means the excess is $1,175,000. We have the customer list. We have the goodwill. And because a premium was not paid, the goodwill is prorated between the parent and the non-controlling interest. So these are our consolidated financials at year end, December 31st. And what we're going to do now is the working paper entries. Now, if you notice, we have this new column called non-controlling interest. That's what makes this one tricky. So remember, you're going to subtract out the net income, and you're going to add in the portion down here that's assigned to non-controlling in Little. So again, you're going to show all the assets 100%, and then you're going to make an adjustment in the equity section. All right, we're going to prepare our journal entries. We have to first zero out the sub's equity accounts. We have to assign the values to the undervalued assets or overvalued assets or any intangible assets. We have to eliminate the sub's income, sub's dividends, and we have to amortize if needed. All right, so our first entry, S, is we're first going to eliminate all the accounts of the sub, and in this case, we're going to eliminate 100% of the sub, but then we're going to allocate it between the parent and the sub, because that's what we have to do in order to zero out the investment account, because we would only show 80% in our investment account. So there's what our journal entry looks like. Here's the amount. We're zeroing out retained earnings. Remember, it's always beginning retained earnings, not ending. We're going to zero out beginning retained earnings, the common stock, and the additional paid-in capital of the sub. And then we're going to allocate it between the parent investment account and the non-controlling interest. Next, we're going to do entry A. We're going to allocate the net fair value and the goodwill. Again, we're going to book them at 100%. Make sure you adjust for any prior year amortization. In this case, we have 1 year. So we have to see what would be the balance at the beginning of 2017. And then we book the goodwill. And then again, we're going to have to allocate 90% to the parent and 10% to the non-controlling interest. So this is what it looks like. We're going to book the customer list and the goodwill. And then we're going to reduce the investment account. And we're going to increase and assign an amount to the non-controlling interest. Now we're going to eliminate the net income of the sub. Now in this case, we have to remember that we're only going to journalize our 90% because that's all that's been recorded as an adjustment to the investment account. And this is where we're going to use that new column called non-controlling interest, because that's where we're going to put the 13.5, which is assigned to the non-controlling interest. So we know that we're going to take the equity income minus the amortization times 90%, and then we're going to take the same thing, the 121, or we should just take the net income, and we assign 10% to the non-controlling interest. Just the way I did it here is I took the 125 divided by 90 times 10. Be another way you could do it. So now if you notice, we have something in that column for non-controlling interest, because that's what we're going to subtract out, because in essence what we're going to be doing is we're going to be adding 100% of the subs and the parent's revenue and the cost of the expenses of the parent and the sub, and then we're going to subtract out, after we do that, the portion assigned to the non-controlling interest. And we reduce again our investment account. Now we have to eliminate the dividends, and again we would have only got 90%, and now we have another item that's going to go in that column for non-controlling interest, because we have to equal 25,000 when we go across, because we need to eliminate this 25,000. So if we take the 22.5 plus the 2.5, that zeroes that out. And then of course we're going to debit Big's portion for that. Now the next thing we're going to do is book the amortization. Since we account for 100% of the assets adjusted to fair market value, we also have to get 100% of the amortization. And we see that right there. Now we can finish. We're going to add across. So we're going to add across except for net income, which is added down, then transferred the total to retained earnings. And we notice that if we take the 1854 plus the 22.5 minus the 769.5, the 985.5, and the 121, it equals 0, which means we've zeroed out the investment account. That's when we know we've done okay. For the non-controlling interest, you add the column and transfer the total to the consolidated total. So what you're going to do in the credit column for non-controlling interest only, you're going to add the 85.5 and the 109.5, transfer that to the controlling interest, and if you notice, it is going to be a credit. You're going to then add your share of the net income minus the dividends, and that's how you get that 206. That's going to be a line item in the equity section. And this concludes this presentation of part 3 of consolidated financials with a non-controlling interest.